Hello and welcome to Accounting with Mr. H. In this video, we're going to look at how to deal with the retirement of a partner, including the preparation of a revaluation account and a capital account. This is going to be quite a tricky question. I have another video which gives a more simple question on this topic. So if you haven't watched that one first, it's a good idea to watch that first to understand the basics of how to enable a partner to leave and then come back to this video. Please do remember to subscribe to the channel, and thank you so much if you already have done. Like, share and comment on the videos what you're finding useful and what you'd like to see in future videos. Right then, here we go. So as I said, there's quite a lot in this question. It is possible to get a question with quite a few things going on, and I've deliberately put a couple of extra challenging things in here to help revise some other topics at the same time, but also to show kind of, a full question of what could actually come up in this topic. So let's get stuck straight in then. So over on the left-hand side, what have we got? Flo, Joe and Mo are in partnership, sharing profits and losses 3-2-1 respectively. Joe retired at the end of their financial year on the 31st of March 2024. The following information is available at the 31st of March 2024. So what have we got? We've been given the property, equipment and motor vehicle at cost. So that would have been the original amount that was paid for it when it was purchased. We've got the value of the trade receivables. And we've also been told that in his current account, Joe has a debit balance of £3,200. Additional information, I'm just going to scan through this and then I'll read it more carefully when I need it in a minute. So it tells me, number one, the property is not depreciated. 2, the equipment, so it's purchased depreciated, so it's telling me about how the equipment is depreciated. 3, motor vehicle was purchased depreciated, so 3 is telling me how the motor vehicle was depreciated. 4, the following valuations were agreed by the partners on the 31st of March 2024. So these are these values that we talked about in the previous video on this topic that the partners have agreed at the time of Joe retiring. 5, it was agreed Joe would take the motor vehicle at an agreed value of £5,100. So as part of his retirement, he's going to take the vehicle. 6, what we got? 31st March, intangible assets, Goodwill. So again, we spoke about those in the previous video, but there is our intangible assets and Goodwill. 7, any monies owing on the retirement of Joe are to be settled through the partnership's bank account. And 8, Flo and Mo will continue in partnership, sharing profits and losses 3-1 respectively. And I'm being asked to prepare the capital accounts for the partnership at the 31st of March 2024. You'll see then I've already got my capital accounts drawn out and I've already been given the opening balances, 35, 30 and 21,000 for Mo, and they're already there entered for me in the capital accounts. So I can get straight stuck in then into my workings. Let me get a workings box up and running. All right, here we go. And you will know then from my other video that if there is a change in a partnership, if a partner wants to retire, leave the partnership for whatever reason, first thing we need to do is to prepare what's called a revaluation account. And this is where we look at the current value of non-current assets and current assets in the partnership's books and compare them to any new valuations that the partners have agreed at the time of the change, a partner leaving or retiring. So let's start having a look through. The property then, we're told in that first bullet point, the property at cost is £190,000. And then additional information 1 says the property is not depreciated. So therefore, the net book value of the property must still be 190,000 because their policy is not to depreciate property. If I look at point 4, it says the following valuations were agreed by the partners on the 31st of March. So it's been agreed with the partners, possibly in discussion with an accountant, that the property is actually or should actually be valued at £240,000. So that's going to be an increase of £50,000. So there's a working that I can see. So currently in the books it's 190. They've now decided it's 240. So that's an extra £50,000 in value. And that 50,000, it needs to be shared out between the partners. Because as Joe is retiring, Joe is entitled to a share of that £50,000 because he was there. He's helped presumably buy the property perhaps in the first place. He's been part of the partnership. So if the property's increased in value, it's only fair that he gets a bit of that benefit of that increase as he leaves. And so I'm going to double enter that into my revaluation account onto the credit side, and I explained why it's on the credit in my last video. Okay, next one we've got equipment. So the equipment, we're told the equipment at cost is £54,000. And I need to know what the net book value of the equipment is. And if I look at point number 2, it says the equipment was purchased on the 1st of August 2022. Equipment is depreciated monthly using the straight line method at a rate of 10% per annum. So I need to work out what the net book value of this equipment must be in their books. So let me start getting a working going. So we're told then it's straight line depreciation 10% per annum. So I can find then, so the original cost of the equipment was 54,000. And straight line depreciation is based on the cost. So 10% of 54,000 is £5,400. They then tell me, though, that the equipment has been depreciated monthly. So that 5,400 is a yearly figure, but they've been depreciating it on a monthly basis, on a time apportioned basis. So I now need to work out how many months they've owned this equipment. So it tells me the equipment was purchased on the 1st of August 2022. So they've owned it in 2022 for the whole of August, September, October, November, December. So they've owned it for 5 months of 2022. They've then owned it for the whole of 2023. So that's 12 months. So we've got the 5 from 2022 plus the 12 from 2023, so we're now on 17 months. And we're currently on the 31st of March 2024. So we've got January, February, March of 2024, another 3 months. So we've got 5 months from 2022, 12 months from 2023, and 3 months from 2024. So in total, they've owned this equipment for 20 months. So you can see I've just added my next bit of working. So I've taken the 5,400 annual depreciation figure, divided it by 12 to turn it into a monthly figure, and then multiplied it by 20 because they've owned and depreciated this equipment for 20 months. And that tells me that they must have depreciated the equipment by £9,000. So now I can calculate the net book value of this equipment. So the original cost was £54,000, take away the £9,000 depreciation, means the net book value is 45,000. And then if I look at point 4, the valuation they've agreed on the retirement of Joe is that the equipment should be valued at 38,000, a bit lower than what the net book value is. So we need to adjust then this, it's gone down a bit. So it's only fair that Joe suffers a little bit because of this fall in value before he leaves. Otherwise, if we don't adjust it now, he'll leave and he'll never have to suffer this. And it will be down to Flow and Mo to suffer it later on in years to come. So just like we did with the property, I'm now going to compare the net book value figure of 45,000 with their new valuation figure of 38,000, and we've got a fall then of £7,000. And I can now put that onto the debit of my revaluation account. Again, I explained in the first video why it's on the debit. Then I need to look at the motor vehicle. So the motor vehicle, it says, what have we got here? The motor vehicle at cost, it says, was £16,000. And then point 3 says the motor vehicle was purchased on the 1st of April 2021 and is depreciated using the reducing balance method at a rate of 25% per annum. depreciation has been charged on the 31st of March 2022, 31st of March 2023, and the 31st of March 2024. So slightly more involved because we've got reducing balance method. So we're going to have to go through 1 year at a time. So let's get underway with this working. So the motor vehicle then, the first time they would have depreciated it, it says was the 31st of March 2022. And at that point, they'd owned it for a full year because they bought it on the 1st of April 2021. So reducing balance depreciation is based on the net book value of the asset. But at the first time you depreciate it, the net book value is the same as the cost because you haven't depreciated it yet. So there's no accumulated depreciation to take away. So the first year, it would have been £16,000, the cost, less 25% depreciation. And so the motor vehicle would then have a net book value of £12,000. Then another year ticked by and they depreciated it again on the 31st of March 2023. So they would have taken the net book value of £12,000 and taken another 25% off. So now the motor vehicle has a net book value of £9,000. Then another year ticked by and on the 31st of March 24 we're told they'd charged depreciation again. So they would have taken the latest net book value figure of £9,000 and taken off another 25%. And so that means on the 31st of March 2024, the motor vehicle has a net book value of £6,750. What's happened to this vehicle though, if I look at point 5, we read this a few minutes back, it was agreed that Joe would take the motor vehicle at an agreed value of £5,100. So the partners have decided, and as he's retiring, they said, yeah, you have the vehicle. We don't need it perhaps in the partnership anymore. They've agreed that as part of his withdrawal of capital, if you like, instead of taking it all as money, as cash, he's going to take an asset in part payment. And he's going to take the vehicle at a value of £5,100. But currently, the vehicle's got a book value of £6,750. So work out the difference between the two. And that means the vehicle the value is going down by £1,650. And so I can now put that in my revaluation. There it is on the debit. And then finally, the other asset we've been given in those bullet points is the trade receivables of £8,250. And in point 4, it says they've agreed the trade receivables are now to be valued at £8,000. So the difference between the two then is just £250. But again, it's a decrease in value, so I'm going to put that on the debit, and there it is. So I've dealt with the revaluation of all of the assets that I've been given, and now it's a case of totaling off this revaluation account and sharing out the net revaluations. So on the credit side then, add up the side with the most on it. So we've just got the credit side with 50,000 on it, that's my total. And then let's get another box of workings. Here we go. So 50,000 on the credit. I'm going to take away all the amounts on the debit. 7,000, 1,650 and £250 means there's £41,400 to share out between the three partners. And unless I'm told otherwise, I do this in their profit sharing ratio, which we were told was 3:1. So flow then is getting 3/6. So 41,100 divided by 6 multiplied by 3. He's getting 20,550. So I can send that to his capital account. There we go. Let's put that in the revaluation. Joe is getting 2/6. He's getting a third of the total amount. So there's my working. Let's put that in the revaluation, send it to his capital account. And Mo is getting the remaining 1/6. And there we go, entered into my revaluation account. And then just as a double check, I'm now going to total up the debit side of the revaluation and just confirm that, yeah, that also comes to £50,000. And there's the revaluation account, which is the big sort of working really, where a lot of the marks are in these kinds of questions. But I've now done that, it's complete. Right, so let's get back to the capital account. I've just put in a yellow box there the completed revaluation account so I can refer to it. So in the revaluation, we've said on the debit, we're sending 20,550 to the capital account of flow. So if I'm debiting the revaluation, that means I'm crediting the capital account. So here we go, let's get these put in, there we go. And then Joe, 13,700 and Mo, 6,850. And then that's the revaluation dealt with, double entered from the revaluation account. Just keeping an eye on the additional information. So I've now dealt with 1, 2 and 3 because that was all about depreciation. And I've also dealt with items 4 and 5, which were about the agreed valuations. So I'm now round to point number 6. Point 6, what we got at the 31st of March 2024, intangible assets, goodwill, were valued at £66,000. It was agreed that intangible assets, the goodwill, would not remain in the books of the partnership. In my last video, I spoke about what intangible assets are and how all this works and why it works like that. So if you can't remember or you're not sure, then have a look please at my other video. I'll put the link in the description below. So I'm going to credit to create the intangible assets, and let's get it working, up and running. So unless it tells us otherwise, we continue to do this in their profit sharing ratio, and it doesn't tell me otherwise. So I'm just going to use this 3-to-1 ratio again. And so flow, that's £66,000. Flow is going to get 3/6 of it, half of it, 33,000. So I can put that onto the credit of flow. Remember, credit to create goodwill. There we go. Joe is getting 2/6. There we go. And then Mo is getting the remaining 6th. So Mo is getting £11,000 worth of intangible assets. And there we go. So I've credited to create the intangible assets, the goodwill. Then I need to destroy the goodwill. So remember, debit to destroy the goodwill. But remember, this is where the change has now happened. You create it while Joe is still there, but then you destroy it between the new partners or the remaining partners in the new ratio. So if I look at point number 8, it says Flo and Mo will continue in partnership, sharing profits and losses 3:1 respectively. So that's now got to be the ratio that I use to destroy the intangible assets. Joe's no longer there, so this is all now about the new terms, the new agreement that Flo and Mo have. But the value of the intangible assets doesn't change. It stays at £66,000. So in my working box then for Flow, I've got the £66,000, but because they're now showing profits and losses in the ratio 3:1, Flow, so 66,000 divided by 4 times 3, or put another way, 3/4 of 66,000 is 49,500. And that's going to be destroyed then on the debit to destroy in Flow's account. And then that means Mo has got the other, or is responsible for the other quarter, 16,500. And then just make sure you put it in Mo's column, in Mo's capital account. Don't get mixed up and put it back in Joe's. Joe, remember, is retiring. So I've now credited the goodwill and I have debited it to destroy it. So where am I now then? I've just got a couple of things left to deal with and then I can be balancing things off. Next thing I'm going to look at, over on the left-hand side in the bullet points, it told me that there's a current account. Joe has a current account with a debit balance of £3,200. Hopefully you know that some partnerships choose to keep separate capital and current accounts, and this partnership clearly does. And as Joe is retiring, he can't have any balances left in the books. So I need to transfer, get rid of this current account balance. So in his current account, they've told me it's a debit balance of 3,200. So I've got to double enter that into his capital account. So if it's on the debit in his current account, in order to cancel it out, if you like, remove it, transfer it, I will need to credit his current account with £3,200. And then if I'm crediting his current account, I'm then going to need to debit his capital account, which is what I'm going to do. Let's put this in. There we go. From his current account, 3,200. Current account balances can be on the debit or the credit. If they're on the debit, then from the partnership's point of view, they're an asset. That's why they're on the debit. And it basically means the partner, in this case Joe, owes some money to the partnership. Joe owes the partnership £3,200. So it's only right then, as he leaves, that he pays that back, and that's why it's ended up on the debit of the capital account. Because the money that he's got on the credit of the capital account, the money he's hoping to withdraw in a minute when he retires, well, 3,200 of it he's not going to be able to take because he owes that to the partnership. And then the final thing I need to do before I get into the balancing and the totaling is just to go back to point number 5, and it would be easy to miss this. And if you remember in point 5, it said it was agreed that Joe would take the motor vehicle at an agreed value of £5,100. So as part of his capital, he's not going to take it all out in cash, as we said earlier. He's taking, and they've agreed, he can keep the vehicle. Well, then that reduces his capital. If you imagine the motor vehicle account, motor vehicle is an asset, so the motor vehicle account is on the debit, but because he's having it, I would need to credit the motor vehicle account and therefore debit his capital account. And that's what I'm going to do here. And so this is going to reduce his capital. So he's keeping the motor vehicle at an agreed value of £5,100. So he's not going to take that cash out of the bank, he's having the vehicle instead. And then lastly then, I can start working out the final figures. My advice is always to start with the partner that's retiring, so in this case Joe. And so let's look at Joe's columns. He hasn't got much on the debit side, but he's got thousands on the credit side. So I know the bank figure is going to end up on the debit side. I can total up then the side with the most on it, the credit side, and for Joe that comes to £65,700. Take away the 3,200 and the 5,100 on his debit, means Joe can take a huge £57,400 out of the partnership bank account. That's the amount that's owing to him then on his retirement. And then I can total his column up. Remember, Joe can't have a balance because he's retired, he's left. So that's Joe finished, done, complete. And then just go to the other two partners that are remaining, carrying on a partnership together. And again, take them one at a time. So if you look at Flo, Flo has got more things on the credit than on the debit. So add up her credit side and it comes to a total of 88,550. Take away the 49,500 on the debit, means Flo has a balance then, a new capital balance of 39,050, which I can bring down ready for her to start the next one. Just total off the debit and bring that down. And then finally, balance off Mo. So he's got more on the credit again, which hopefully that's what you would hope would happen in a capital account. So add up his credit side, take away the 16,500 on the debit. There's his balance, 22,350. Total to double check, and then bring down, and there's the capital accounts complete. Thank you for watching this video of accounting with Mr. H. Please do subscribe, share, like, comment on what you'd like to see in future videos, and I will see you soon in another video.